Welcome to the Deep Dive from Talk Tickers. We're your shortcut to understanding the core insights from company earnings calls.
That's right. We sift through the details so you don't have to.
And today, we're digging into the Destination XL Group, that's DXL, their first quarter fiscal 2025 earnings call.
Yep, just happened. And, well, it paints a picture of a tough retail world out there, but also shows what DXL is trying to do about it.
Absolutely. You know, the results definitely reflect that challenging environment, but management, they laid out their strategy, their actions, and maybe a look towards some improvement later in the year.
So our mission today, break down the key numbers, get into what management's thinking about the business, the customer, all that stuff.
And figure out what it all means going forward. Consider this your essential briefing on DXL's Q1.
Distilled right from the source call. Let's jump in.
Okay, let's unpack this. Where do we start? The numbers, right? The top line snapshot for Q1.
Right. The headline figures, they kind of set the scene. Net sales for Q1, $105.5 million.
Okay, and how does that compare?
Well, it's down from $115.5 million same time last year. So a noticeable drop.
Yeah, that is noticeable. And the comparable sales, that usually tells a clearer story, doesn't it?
It really does. Comp sales decreased 9.4% for the quarter. That's pretty significant.
Oof, 9.4%. Did they give any color on how that trended within the quarter? Sometimes you see shifts.
They did, actually, and it's interesting. They saw like a sequential improvement month over month.
Oh, like it got less bad.
Kinda, yeah. Comps were down 13.9% in February. Then it improved a bit, down 8.2% in March, and then down 7.2% in April.
Okay, so the rate of decline slowed down as Q1 progressed.
It is.
Yeah.
They pointed to that as, maybe a sign things were stabilizing somewhat.
But what about since the quarter ended? Any early reads on Q2?
Yeah, they gave a little peek. First 3 weeks of May, comps were down just under 10%.
So back around that Q1 average suggests the pressure is still very much on.
Pretty much, yeah. Consistent with the overall Q1 result, those headwinds are still blowing.
Okay, so with sales under that kind of pressure, profitability must have taken a big hit, right? What's the story with EBITDA?
You nailed it. Earnings before interest, taxes, depreciation, and amortization, EBITDA. It was dramatically different. Only $100,000 for the quarter.
Wow, $100 case compared to what last year?
Compared to $8.2 million in Q1 last year.
Whoa. Okay, that is a massive drop. Really shows you the impact of lower sales on leveraging their costs.
Absolutely. Highlights just how sensitive profit is to those sales levels.
Okay, profitability hammered. What about their cash position? How did they end the quarter there?
They finished Q1 with cash and short-term investments of $29.1 million.
And that's down from?
Down from $53.2 million a year ago. Now, important context there. Over the last 12 months, that decrease includes $13.6 million they spent buying back their own shares.
Right. Okay, so share repurchases were a factor in the cash decline. Did they even mention debt? Any outstanding?
Zero. No outstanding debt. They made sure to emphasize that. Called it a key strength.
Yeah, that's definitely a positive in this kind of environment. And free cash flow.
That was a use of cash in Q1. $18.8 million used.
Compared to last year.
Last year was also a use, but smaller. $7 million used in Q1 24.
Yeah.
They mentioned Q1 is typically a cash use quarter for them, seasonal inventory build, paying out bonuses.
Right. Makes sense.
But the bigger outflow this year was mostly the lower earnings, plus some timing stuff with inventory payments. They actually pulled some inventory receipts forward.
Why is that?
Concerns about potential tariffs, apparently. Wanted to get ahead of it.
Gotcha. Okay, so summing up the quarter, sales down, profits way down, cash used, but critically, no debt. A clean balance sheet.
That's the picture.
All right, now let's take that deep dive. Let's get into the why and what they're actually doing. First off, what's really driving that sales decline?
Well, management pointed mainly to lower traffic, fewer people coming in.
Just in stores?
Nope, stores and online. They said traffic was challenging in their direct business too. And it wasn't just fewer shoppers.
Uh-oh. What else?
Pressure on average order value, how much people spend per trip, and also units per transaction, like how many items they buy.
So fewer customers, and those who are shopping are buying less each time. Ouch. What's their take on the customer's mindset right now?
They believe their core guy, the big and tall customer, is feeling the squeeze financially, the current economy.
Makes sense.
And because of that, he's maybe not prioritizing spending on apparel, especially their category, as much as he was. They said customers still appreciate the fit, the experience when they come in, but they're just being more cautious with their spending.
Yeah, that tracks with what we're hearing elsewhere. So in that environment, value becomes super important, right? How's that playing out in what people are buying?
It is. They talked about that shift. Customers are leaning more towards value, and that means higher penetration of their own private label brands.
Their own brands versus the national names. How much of a shift?
Private label mix went up to 57% of sales this Q1, compared to 55% last year.
And why is that shift important for DXL's business?
Well, generally, private label brands have better margins for them than the national brands. Plus, they have more control over pricing, supply chain.
Right.
So that shift helped partially offset the fact that they had higher markdowns in the quarter.
Okay. Markdowns were up. Why was that? More sales.
A few things, yeah. Partly strategic. They use promotional offers
Right.
like buy one, get one deals to try and drive some traffic.
Okay, proactive discounting.
Right. And they also launched some new marketing things like the Fit Exchange and Heroes Discount, which have discounts tied to them. And then there was a calendar thing.
Oh.
Their usual March clearance event got pushed into April this year because of when Easter fell. So more clearance activity hit the Q1 results than usual.
Got it. So deliberate promotions, new program discounts, and a calendar shift all pushed markdowns higher. But the private label shift cushioned that margin impact a bit.
Exactly.
With all that going on, how's their inventory position? Are they stuck with a lot of unsold stuff?
Actually, no. They seem pretty positive there. Described inventory as being in great shape.
Really? That's good news.
Yeah. Fresh spring goods are in. Total inventory balance was actually down 6.4% compared to last year. And they highlighted inventory turnover improved by over 30% since the pandemic. Say clearance levels are right where they want them long-term, around 9.5%.
Okay, so managing inventory well, despite the sales softness, that is a positive sign. You mentioned tariffs earlier. What's the latest thinking there?
Yeah, they touched on that. Based on current policies staying put for the rest of the year, they estimate less than a $2 million hit to costs. About 40 basis points, they said.
Okay, not huge, but not nothing. How are they mitigating it?
Mostly through their vendor relationships. They stress that most of their private label stuff comes from places like Vietnam, Bangladesh, India.
Yeah.
Less than 5% from China now.
Right. Have they decided if they'll pass those costs on, raise prices?
Not yet. Still assessing, they said. It's that classic balancing act, right? Do you take price to protect the margin percentage or hold prices steady, maybe lose a bit of margin, but potentially grab market share if others raise prices?
Tough.
Yeah. They haven't made it yet. Haven't changed retail pricing because of this so far. Watching closely.
Okay, so relying on vendors, delaying the pricing decision, let's pivot back to those strategic things they're doing now. The initiatives to fight back against the traffic drop and boost that value perception.
Right. Several key programs there. One is how they're doing promotions. They call it always on value.
Meaning
They're trying to avoid just like blanket 20% off everything sales. Instead, they're using more targeted offers. Trying to get new customers, get current ones shopping more, bring back people who haven't shopped in a while, more surgical with the discounts.
makes sense. And they mentioned specific programs like the Heroes discount.
Exactly.
Yeah.
That's for active military, first responders, teachers, veterans. They highlighted its success in bringing in new or reactivated customers.
Any results on that?
Yeah, and this was interesting. Customers using that Heroes discount, they actually spend almost 10% more per trip than other customers.
Huh. That's a nice little bonus. What about the Fit Exchange? That sounds different.
It really is. And very timely. It's based on insights about customers using those GLP-1 weight loss drugs.
Oh, right. Like Ozempic and Wegovy users.
Exactly. The program lets customers bring in clothes that don't fit anymore, donate them through DXL, and get a 20% discount on their purchase that day. Apparently, their research showed guys using these meds prefer donating the old stuff.
Wow, that's clever. Directly tapping into a major trend. Is it working?
Seems like it. The results they shared were pretty strong. Fit Exchange participants shop 51% more often.
51%.
Yeah, have a 39% higher average order value, and buy 29% more items per transaction compared to the average DXL customer.
Those are big numbers.
And 26% of the participants were new or reactivated customers. So, yeah, seems like a smart play hitting a specific need and driving good results.
Definitely impressive for a new program. They also had a price match guarantee.
Yep, introduced late last year, just trying to build confidence that you're getting a fair price. They said their brand tracking shows a 12-point jump in value perception since they put that in place.
Okay, lots of focus on value, promotions, specific customer groups, and engagement too, right? New loyalty program.
They did, launched in Q1. Goal is to really connect with their best customers. Early signs are good, they said, Membership signups are running 46% ahead of what they expected.
That's strong.
And they're seeing good sales when people redeem their loyalty certificates. Still early, but they're encouraged. See it as key for repeat business.
Okay, shifting gears to digital. They've been redoing their website, haven't they?
Yes, big project. They finished migrating to a new platform called Commerce Tools right at the end of March.
So the foundation is built. Now what?
Now, the plan for 2025 is to build on it, add enhancements. They mentioned things like AI shopping help, more buy now, pay later options, better personalization, all aimed at making the online experience smoother and getting more people to actually buy. Improve conversion.
Makes sense. And they're expanding where they sell online too. Nordstrom. Travis Matthew.
Right. The Nordstrom Marketplace thing just went live in June. Put DXL stuff, 37 brands, over 2,200 styles in front of Nordstrom's online shoppers.
That could be significant exposure.
Could be. They have marketing plans lined up with Nordstrom for Q2, including the big anniversary sale, a way to maybe find new customers.
It's Travis Matthew. Is that similar?
It's a collaboration, an exclusive collection with Travis Matthew, but specifically designed for the big and tall guy using DXL's own fit specs. Kind of like what they did successfully with Untuck It before, blending a popular brand style with DXL's fit expertise.
Speaking of fit, that fit map technology sounded pretty cool.
Yeah, they seem really excited about this one. It's proprietary tech they've licensed long-term till 2030. Basically an in-store body scan using an iPad in the dressing room. Gets really accurate measurements.
Okay. And the vision is?
Long-term. You could use that digital scan anywhere online, maybe even for custom orders someday. That's the dream, I think.
Sounds very sci-fi for apparel retail. How's the rollout going?
It's happening. Over 20,000 guests scanned already. It's live in 52 stores now.
Okay.
Plan is 85 stores by the end of this year, maybe up to 200 by the end of 2027. And the key thing, the data.
What's the data show?
Guests who get scanned. They have higher average order values, higher lifetime value, and they shop more often than customers who haven't been scanned. So it seems to be working, driving engagement and value.
Interesting. Okay, let's tie this back to the physical stores. Traffic down, that's driving like 90% of the comp decline in existing stores, they said. What's the plan for the actual store footprint?
Well, they have been opening new stores. 4 opened in purely Q2, 4 more planned this year. That gets them into 18 totally new markets over the last 3 years.
Okay, expanding into new territory.
But they also announced they're hitting pause on further new store openings after they hit those 18.
A pause? Why start now?
Performance in those new stores has been, well, challenging. That's what they said.
Same traffic issues.
Seems like it. Maybe even worse because of low brand awareness in places where DXL is totally new. So the decision to pause is about focusing resources, conserving cash, and stabilizing the core business first.
Makes sense. Don't keep spending capital on new stores if they aren't ramping up as hoped in this environment.
Exactly. You basically said more aggressive expansion makes sense later after they can support it with a bigger brand awareness push. Pragmatic move, really.
Okay, stepping back, putting this in investor context. Management's core message seems to be, we're in an economic downturn.
That's the frame, yeah. Macroeconomic pressures, consumer sentiment, hitting discretionary spending. They see that as the main reason for the sales and profit drops. Their category, big and tall apparel, just isn't a top priority for cautious consumers right now. That's their rate.
And all these strategic things we just talked about, the targeted value, loyalty, fit map, collaborations, website upgrade, these are their weapons to fight back.
Precisely. These are the levers they're pulling. Trying to drive traffic where they can, make customers feel they're getting value, improve the experience online and in store. The goal is to, manage through this tough period and be ready for growth when things turn around.
And that balance sheet strength we talked about, 0 debt, cash on hand, available credit. Why is that so crucial right now?
Oh, it's absolutely vital. Having that fortress balance sheet, as the lady put it, the $29 million cash, 0 debt, $77 million available on the revolver. That's huge financial flexibility.
Gives them options.
Exactly. In a retail downturn, cash is king. This allows them to keep funding those strategic initiatives, rolling out FitMap, enhancing the website, doing the targeted promos, without worrying about just keeping the lights on. It buys them time and stability to execute their plan.
So that financial strength is basically what lets them play offense, or at least targeted offense, while others might be purely defensive. And pausing the new stores fits that narrative.
Perfectly. New stores eat up capital upfront. If they aren't performing well right now, pausing that spending directly conserves cash flow, lets them put that money towards the core business and the initiatives they think will drive better near-term results across the board.
Okay. This is where, we pivot a bit. Let's put on a different hat. We need to be super, super clear here. What follows is purely a thought experiment, brainstorming based only on the info from the earnings call.
Absolutely critical disclaimer. This is not financial advice, not investment recommendations. Do your own homework. Talk to a pro. Seriously.
Seriously. Okay. Disclaimer locked in. Let's float a couple of, let's call them hypothetical trade ideas, just playing with the information. Idea number 1, the fortress balance sheet play.
Okay. I think I see where this is going.
You have a company, DXL, stock price way down from its highs. Operations are clearly struggling in this economy. But that balance sheet, 0 debt, decent cash, big credit line available. That's a rock-solid foundation compared to a lot of retailers drowning in debt.
Right.
So the hypothetical idea is maybe that balance sheet itself provides a floor under the stock price, limits the downside risk, even if sales stay weak for a while. Plus, it gives them options, right? They can outlast weaker competitors. Or maybe, just maybe, and they didn't say this, a clean balance sheet in a beaten down sector makes them an attractive target for someone else down the line.
So the speculative angle isn't banking on a quick turnaround in sales, but on the underlying value and resilience baked into that financial structure itself.
Exactly. How might someone hypothetically express that view? Again, pure speculation. Maybe long-dated call options. Betting that over time, that balance sheet value asserts itself or leads to something strategic, or, made more complex, a pair trade. Go long DXL because of its financial strength, short a competitor retailer that's loaded with debt. Betting DXL will hold up relatively better purely because it's not financially stressed.
Interesting. Focusing on financial health as the key differentiator in a tough market.
Okay, idea number 2. Let's call it the hidden tech optionality bet.
This has to be about FitMap.
You got it. They spend a good amount of time talking about FitMap. Proprietary tech, licensed long-term, rollout progressing, 20,000 plus scans, data showing scanned customers are better customers.
Right. They're using it now to sell clothes better.
Correct. Using it within the core apparel business. But think bigger picture, hypothetically. This technology is creating a unique data set of detailed body measurements linked to apparel preferences and fit. Could that technology or that data eventually have value outside of just DXL selling shirts and pants?
Like licensing it to others or spinning it off.
Potentially. Could other non-competing apparel companies want access? Could it become its own standalone tech venture if it scales up enough? It's a long shot, maybe, but the idea is betting on the intellectual property itself, that there might be this hidden asset value in the FitMap tech and data that the market isn't currently pricing into what it sees as just a traditional retailer.
So a speculative bet on the future value of the IP, kind of independent of how well they sell sweaters next quarter.
Pretty much. A bet on tech optionality buried inside a retailer. Again, just thought experiments, playing with the info they shared.
Got it. Disclaimer, still flashing.
Okay, let's bring it home. Summing up this deep dive on DXL's Q1, what are the main takeaways?
Well, clearly it was a tough quarter. Macroeconomic headwinds are real, hitting customer traffic, hitting spending. That flowed through to lower sales and much lower profits compared to last year. No sugarcoating that.
But importantly, they aren't sitting still. They have a plan, initiatives underway.
Right. Actively working on things they can control. That means targeted promotions, the new loyalty program to engage best customers, improving the website, trying new channels like Nordstrom, and really leaning into that FitMap technology, all aimed at stabilizing things now and setting up for later.
And the bedrock enabling all this activity, that strong balance sheet.
Absolutely critical. 0 debt, good liquidity. That gives them the breathing room, the flexibility to keep investing in these strategies, even while sales are soft. It's a major advantage.
So maybe the final thought for you, the listener, to chew on is this. DXL management is guiding for potential positive comparable sales in the second half of the year. Given everything we've discussed, the challenging environment, but also their strategic responses like the value focus, loyalty, FitMap, conserving cash by pausing store openings, is that enough? Are these internal actions potent enough to overcome the external pressures and actually deliver that turnaround back to growth later this year?
That's the million-dollar question, isn't it? How much can strategy offset a tough economy?
Indeed. And one last time, please remember, everything discussed today comes from our analysis of the DXL earnings call content. It is absolutely not financial advice.
Our goal is just to break down the call, give you the key points and context. What you do with that information is entirely up to you.
Thanks for tuning into the Deep Dive by Talk Tickers. We'll catch you on the next one.